The Hedgeless Horseman here. It's April 23rd, 2025. In this video, I'll basically put some perspective, I was gonna say, on how a bull market is supposed to feel. I guess it's a correct word. First of all, thanks to the sponsors. Let's look at the markets. Commodities, mixed bag. Silver up a bit. Gold down 3.87%. At $3,288, which is still absolutely crazy. It's been a risk-on couple of days, so markets are, panic rebounding, and crypto is making the most of it since it's risk on and going up even more than the overall market's rate seems to be going down. Don't know really why. Obviously profit taking, some rebounding, yada yada. But yeah, basically noise like every day. This doesn't mean anything. Markets could be limit down tomorrow. Gold could be limit up tomorrow. You never know. And of course, the reason why people sell or buy is not typically because they think something is cheap or expensive. It's because they're guessing they could be up more tomorrow or down more tomorrow. So if gold is down now, anybody who's selling right now when a miner is already down or a junior is already down, for example, it's not because they think it's expensive all of a sudden, because gold is down to almost record highs of 3,291. It's because they think somebody else is going to sell it lower tomorrow, and they don't want to see a paper loss any day. That's how it is. That's how it's always going to be. But I would maybe I'll start with something here. Yeah, so let's get something straight. Absolutely a vast amount of people have no idea how a 5-bagger feels or a 10-bagger feels, how a bull market feels, especially, I guess, in the juniors, given the last several years, and especially if you bought in at 2020 or 2021, for example. So everybody thinks that, and I think I discussed Lundin Gold yesterday, that for the vast majority of the time, Lundin Gold, even though it ended up being a multi-bagger over years, 80-90% of the time, the stock did not really go anywhere. So I took a look at Snowline. Pretty much absolutely the same thing here. Most of the time, even though you look from this period here of let's say 50 cents to $8, so that's a 16-bagger over just a few years, absolutely absurd returns. And people wrongfully think that if a stock goes up 16 times over just 3-4 years, it's an easy ride. People are cheering all the time. Everybody's making money every day, basically. Nothing could be farther from the truth. Most of the time you can't really, on any given time frame, you can't really tell if a stock is in a bull market or a bear market, not even for one that's going up or went up 16 times over 3-4 years. Here, topped, went nowhere for a year, topped, went nowhere for a year, went up a bit, went nowhere for, I don't know how long this is, months. Then the discovery went up, topped, went nowhere for around a year, went up a bit, went nowhere for 1-2 years, went up, and all of a sudden you have a 16-baggers. The actual net gains, the only time the position was more in the green than it had been before, happened during very, very brief time periods. this was the most impressive one here, and then for it was this week, okay, so over a month, let's say, and then it went back to consolidation, then 1.5 months revaluation, and as you can see, after every time it made a higher high, typically retraced a lot of the move, not every time, but I mean this move here got retraced by 60% or something. This move here got retraced by 100% basically. This move here got retraced by more than 100%. This move here got retraced by 100%. This move here has been was retraced by 70%. That is how crazy the volatility is. So it's like you can almost never tell. Even you can, only when you zoom out you can realize, years later that, oh my God, because obviously as well it's like up here it's at $6, so that's like a 10 bagger from 60 cents. Down here it's $4. That's much less than a 10 bagger, but it's still a huge return, of course, for anybody that's held it. My point is that, like, bull or bear, most days the portfolio and stocks are absolutely gonna go nowhere. I mean, especially from a net gain basis. Here it went up obviously, but then it went down. Went up again quite a bit, but not to new highs. Then new highs, then to new lows and new highs. Down, up, down, up, down quite a lot, up a lot, down a bit, up a bit, new high. So, I mean, at what point, how many, what percentage of the time do you think people are sharing in Snowline? I mean, again, if you look at the net size of the position or total returns, even, for a hodl position, that's after 3-4 years is up 16 times. Let's say 1,500%. Absolutely absurdly good return over 3 to 4 years. Most of the time, that holding was not exciting. Because you know how it is. I mean, you always want to make more and more money. So it's like, really the only time I think people were kind of celebrating in a sense is in periods when they're seeing net gains in the position returns, and those net gains pretty much after every new net gain, it gets retraced by a lot. I mean, this is 50% retracement, for example. So after you shear, which only happens maybe 5 to 10% of the time max. After that, typically you get 50% corrections or 30 to 50% corrections, which is, I mean, for most people feels absolutely horrible. That's the thing. It's like people think that a bull market or a stock in a bull trend or whatever, that it's gonna feel good. Like it's gonna feel completely opposite of what a bear market feels, and that's actually not true. Most of the time a bull market will feel exactly like a bear market. The only difference is that 5 to 10% or something of the time, the stocks and the portfolio is going to surprise to the upside for a brief period, and then it's going to go into consolidation again. Whereas in a bear market, it's more that the portfolio or the stocks are going nowhere, but 10-15% of the time they go lower. So you can't really tell. A bull market doesn't feel good. A bear market doesn't feel good. And 80+% of the time you can't even tell, in a sense, if it's a bull or a bear market. It's just a long time later you can tell. And that's, of course, I mean, what is everybody focusing on? Really, I mean, I would say 90% of people focus on getting all of these waves Correct, right? Because no, again, no, the main goal of pretty much everyone in practice is to never uh, be a part of a decline. That is the main focus almost everyone has. That's why people are selling today, because they think they could go lower tomorrow, and they don't want that because they're already down today. Being down tomorrow as well, it's too much to bear. So basically 90%, and that goes for whatever, the biggest, let's say, typically accounts, FinTwit accounts and paid services, etc. Pretty much everything is centered around what the next short-term move is. The whole, financial market and retail, whatever. It's like and you can watch CNBC or whatever. It's like most of the segments and time is typically about what they think is going to go up or down in the short term. That's it. The whole industry is basically centered about around getting, buying before something goes up, selling it before it goes down, buying it again when it goes down, selling it before it goes down, yada yada. And yet, only 5% of active investors can outperform a respective index. So basically, less than 5% of the people could outperform, in a sense, Snowline by trading it. 19 people out of 20 will have less returns in Snowline than anybody just holding it through and not even trying to predict all these moves. And I would say it's probably, from a life balance perspective, whatever, I think it's makes sense. I mean, if you would just hold this, you don't have to do anything, and you're gonna outperform 19 out of 20 people who periodically, let's say, own Snowline and stuff. And that goes for stock indices, of course, as well, as we're going to look at. But this is absolutely true. Get rich quick. I mean, that's basically, that's the focus also. You can look in the forums. I mean, basically most of the talk is about if, when the stock is going to bottom, when it's going to top, where it's going to go in the short term, etc., etc. Look at any forum, or I mean, a lot of it is, of course, pumping and bashing, etc., to try and get it in the short term to some direction, let's say. So I'm in this camp, slow and steady gains, and that means I have to accept the fact that vast majority of the time my portfolio will not be making new highs. And we're actually gonna look at an example of I decided to look into a hodl folio. Well, yeah, this is what I mean. A bull consolidates 80% of the time, net gains 20% of the time. A bear consolidates 80% of the time, net loss 20% of the time. So most bear or bull, big bear market or the biggest bull market, most of the time the stocks go nowhere. So this is a family hodl folio. You have to really, I mean, if I zoomed into this period here, it looks like the portfolio is in a bear market. If I zoom in and just look at this period, it looks like the portfolio is in a bull market. Here it looks like it's, I guess, a sideways market, or from here to here, looks like it's a bull market. Here it looks like it's a bear market. Here it looks like it's a big bear market. Here it looks like it's a big bear market. Here it looks like it's a bull market. So if you look at this portfolio, which is like, I mean, given how shitty the average junior has performed, let's say, I'm quite happy with this family portfolio's return. Almost, very little trading. Very little trading, mostly us holding stuff. And here you have the I think this was the flash crash, so the entire portfolio went down probably 40-50%. You're losing money on paper very quickly. Didn't take too long for that to go away, and actually it went even higher. So 40-50% decline in the portfolio didn't really matter that much, because every holding was too cheap, and in a year or year and a half, the market, painfully started to agree with that. Then we got into a new correction, and the portfolio was too cheap. Then it went up, then it went down. So it's getting cheaper and cheaper, way too cheap. Then it goes up, and I think this was the Condor decline, for example. So if this hadn't had such a big position in Condor, this top here would be maybe up here or something. So kind of more of a clear higher high than here. But that's so 2 years to make another net high. And after it made a brief net high, it's already consolidating in a sense. And you can see the same phenomena. Consolidation net high, retraced the whole movement, erased 1.5 years of net returns. So all of a sudden I'm looking stupid, basically, like I've lost money from my investing ventures. Not too long after, portfolio is in the green again. Then it's even more in the green. This whole net high run here got retraced and then some before going up back. New net high, retraced this entire net high move down here. But you see, it's still, typically this is actually a lower low. Didn't matter. It was totally irrational sell-off. COVID flash crash. But overall, over time, high here, a bit of a higher high, a bit of a higher high, a bit of a higher high. And I, of course, expect this higher high here to also get surpassed. But you have to really zoom out for this to look like, to discern even an uptrend. And this is not a bad return for a passive hodl folio, given what the average junior has done. So I absolutely, this is outperforming GDXJ, and I would say GDXJ has outperformed juniors by a long shot over this period of time, and this portfolio is beating the GDXJ. So obviously that's outperformance. But was it a smooth ride? Was it super easy? Was it this portfolio is printing money most of the time? No. Again, as you can obviously see, most of the time, this portfolio went absolutely nowhere. Half of the time it went up, half of the time it went down. Net gain periods were quite brief, and every net gain period basically got retraced and then some, before going higher to another net high period, and then retracing more than that entire move. So, literally, you can see that every new net high period, not too long after, it retraced the whole thing. It went lower than the breakout point. But at the end of the day, you have positive returns. And this is why, in a sense, I think I make that point somewhere. Statistically new. Okay, so this is the Huey. This is the big bull market from late 2000 to 2008. If you look at bottom to top, this was a 1,300% gain in an index, in a mining index, over 8 years. So a 13 bagger, let's say, over 8 years. Really, really good returns. Anybody would obviously be happy, would be beating the S&P by a mile and all that. Remember that 95% of people who were in miners probably did worse than the index, because they were trying to trade every single week, etc., etc. So the ones who just held the Huey for 8 years in this bull made more money than 95% of people trying to trade Huey. And then we can also see there's how many periods were people, how many periods did it feel like you were printing money, or that the strategy, the portfolio was even working. I would suggest that people would only think that during net gain periods. Here was a brief net gain period, long consolidation, brief net period, consolidation much longer than the time it went up. This was a pretty good net gain move, but as you can see again, retraced pretty much the whole move. Small net gain period, retraced that net gain and then some, and consolidated for 8 times the time length that it went up. Net gain, this was one of the more impressive ones, consolidated, and there's small consolidations in between. Up, consolidated a bit, went up to a new net gain. This entire, almost the entire net gain period back to here got retraced before it went up again and made a new net high, consolidation, net high, consolidation, erased the net gain here, erased the, not all the net gain here. So this was actually one that didn't, the only one really in this chart that didn't totally get retraced before going higher. Pretty much every single net gain period retraced the previous net high or lower, I was going to say. I mean, this was a small net high, but it retraced this move, obviously, and much more. Almost this entire run here, yeah, got retraced. So this wasn't retraced totally. This net move got retraced and then some. I mean, this was the net run here, but it went way past that. Net high, retraced the whole move. Net high, retraced the whole move. Net high, and that was the top. So again, imagine you're sitting in this bull and you're sitting on Huey. You don't know it at the time, but from bottom to top, this would go up 1,300%. At what point, again, at what point was it easy to sit in minors? At what point did it feel like your portfolio is actually working, that your strategy, did it feel good when you sat for 2 years without this portion of your portfolio doing anything and spent half the time, going down? I don't think so. I absolutely don't think so. And this is very, people don't admit this, but it's like, you see people whining. It's like people are whining today. I mean, it's impossible that nobody has had any updates over the last, let's say, 6 months or something, in any junior. And some juniors might have like 3 updates in a row. As soon as a down day comes, they're bitching. But of course, that is because most are still down in juniors. I mean, most people own, in my opinion, companies I wouldn't like to own. I mean, they don't have necessarily any real value. So it's basically they're not cheering or they don't think it's impressive until they have a net gain, until they're up. So if, let's say, the portfolio is down here, it goes up like that. They don't cheer, obviously, because they're still in the red. Then it actually takes a pause and consolidates. Then they really get mad. Then it goes up, and they're not cheering yet because the portfolio is not green yet. Then it starts to retrace. Then they bitch again up here. So now they're, okay, soon I might be able to sell at a profit loss of 0, neutral, get out with no gain but no loss. Then it retraces again. Then they're gonna be bitching. This is the only time they're actually gonna be, I think, happy and think it's working and happy with their decision to be, in this case, the Huey, and especially up here. But then this is gonna happen. Then they're gonna get pissed off again because now they're only up. If they bought this top, they're only up this difference instead of this difference. And then it kind of starts again. So they're disappointed. and now it goes up, but they won't be shearing, of course. They don't care if they're up from here to here. They know they used to be, up this much. And then they're going to be pissed about they're not going to be happy about any rallies, and they're going to be pissed at every single down day, every single consolidation. So it's like, my point is like, no, how many people do you actually think made a lot of money in during this period? Or even if they did, how much do you think they actually enjoyed their time in this sector? I don't think people feel like it's a bull market even when you're in a historic bull market. And in a sense, the way I look at it is like, I think every single holding I own is cheap, right? Same goes for the hodl portfolio. Not that every case will play out and prove to be cheap, but still. So if it's undervalued, it means, the intrinsic value is higher, and sooner or later it's going to gravitate towards fair value. And you can see that the trend is up. But during those times, most of the time every single holding spends consolidating, because that's, in a sense, I guess, how one can look at it. If something is undervalued, every down day is part of a consolidation. If something is overvalued, every down day is repricing it towards fair value. So if stocks I owned here, if they were actually worth this much in reality, this was just a consolidation, broke, revalued, maybe the fair value, then they got cheaper, and I think they're worth actually this much, consolidated for a long period of time, then it priced that in, and then it consolidated again. But my point is, like, if you own something that is legitimately undervalued, and you're not going to be right on every single case that it is undervalued, and some might be high risk, high reward cases that are undervalued but still only have like 20% chance of success, so 20% chance that they are actually undervalued. So if a case fails, it shouldn't go up, right? Then it is not undervalued. It doesn't prove to be undervalued. If you think it's undervalued from a risk-adjusted basis and it works out, you're probably just simply, you're gonna just make more. That's why it's, good risk-reward maybe in your eyes. And we can see that holding period of stocks in years. So basically, now more than ever, everybody is focusing on getting every top and getting every short-term top and bottom correct. So the time frame for most people is like, I don't know, sometimes maybe a week or something. That's why I keep saying that. In my opinion, I don't think the market in the junior sector, for example, cares about any news release, even if it's expected to be a net positive thing, increase value. If it's more than 3 months out, I don't think the market gives a shit. That is not being priced in today. The thing, of course, with time is that it passes. So if you think there's good potential of some positive catalysts 4 or 5 months from now, nobody gives a shit now, but in 4 months they're gonna start giving a shit, and that is maybe when you get some price movement. That's when the market might be starting to price in the positive catalyst that you saw 4 or 5 months earlier. But even if the market saw it, they didn't give a shit, because they're looking for this the positive catalyst that's coming next week. So they're bouncing around stocks all the time, let's say. And jumping into stocks which have, quote, momentum, etc. And there's a lot of people on Twitter, you can see, that basically does that. They're chasing momentum stocks and all of that, and typically fanning the flames, because thereafter they want quick, fast returns and want other people to buy it, so they get even quicker and better returns. I don't feel comfortable doing that. It's like I don't comment too much on microcaps, for example, because my following is I mean, getting quite high, and I don't want to, let's say, make a living in a sense, pumping and dumping. That's why I'm mostly focused on hodl stories. That's why it's like my top 15 uh, hodl portfolio that I actually have on my website. That's pretty much the top 15 I have in most family portfolios. Not all, because some have smaller portfolios and only have like 10 names or something, and some I might have a bit of higher, risk tolerance, for example. But on average, like those are cases I think you could actually just sit in, and I believe you're gonna be making money in them. So you don't need to trade them. But otherwise, if I wanted to try to make a lot of money quickly, in a sense, I guess one would just I would take up illiquid positions and pump the shit out of them so they go up, so I can sell into that. And of course, the more money, the bigger the portfolio, the more you kind of need to pump, the more liquidity you need. But that's I mean, I have a very hard time doing that. I mean, I own some microcap companies and all of that, but I don't try to. Yeah, I don't want to make. I don't want to make money from getting people to buy it, because then it's not actually about the case. Then the whole case for me would be to just get people to buy up that piece of paper. Then it's not actually long-term fundamental investing. For example, with that said, I mean, if something was very, very cheap, I liked it a lot, and for some reason it exploded higher on no news, yeah, then I would probably do some value shuffling. But I try to focus on most of the time on cases that are legit, that I honestly believe that I or anyone could buy, wait 3 years, and there's a decent, depending on the risk profile, decent to good chance that it's going to prove to have been too cheap today. So yeah, holding periods of stocks in years, and of course this base. I mean, the funny thing is, like, I mean, this is pretty much when I think Bitcoin was born, and today crypto is a thing, which makes again total sense. For if you're investing in companies, juniors, whatever, you have to wait for fundamentals to change, news to happen, value to be created, but that takes time. It's like some people say, it's like everything takes longer time in the mining sector than anybody thinks, and I would agree with that. It's like you wait for months for for the field season to start, and then you wait a month for drilling, and then you wait 2 months for assays and stuff. So it's like it's uh, nothing really happens that fast typically in mining, and that's too much to bear for a lot of people. Whereas like in crypto, there is no news you're waiting for. You're just waiting for a trend to start at any point in time that's not related to any news, because it's not like, well, not directly at least. It's like, yes, you might, you might be riding. It's like, oh, a Bitcoin strategic reserve or whatever. But it's like there's no change to Bitcoin itself. It's just you're looking for or waiting for the flow of funds to start, in a sense. And I mean, the same goes for the sentiment beta in juniors. I mean, they might kick off at any point in time and might go, almost straight up for weeks or months. That can absolutely happen. Of course, that's why everybody kinda is in this sector. They're not after these periods or these kind of charts, actually. No, they're only after this. They're only after this. Only after the rocket rides, let's say. But how often does that actually happen, even in a 16 bagger like Lundin Gold? Or whatever bagger this is, actually more than 10 baggers. Yeah, more than 10 bagger. How often has Lundin Gold been a rocket ride? On a net basis, almost never. It's like 5% of the time. And now everybody obviously is excited because now it's literally going, vertical. thanks to the gold price, which makes sense because the gold price has been going vertical, and this is a producer. So it makes sense because the value of the ounces they are selling have gone straight up recently. Is that irrational or not? I mean, in a sense, hey, the gold is going up, so the value of their production is going up. But it's like, at how many points, even in a 10 plus bagger, is it just a rocket ride? Almost never. Pretty much almost never. So my point is, how often should you be excited about the action in your portfolio? I mean, I'm not a trader, of course, because traders, their only focus really is to try and find these rocket rides. But if you're a long-term, let's say, value investor, and you're waiting for cases to literally play out from a fundamental perspective that makes the purchase price you paid once you bought it to look cheap in hindsight. Whatever the fundamentals for Lundin Gold were here, obviously they're much better here. And that's why you made money, and that's why this price is much higher than this. You're betting on, things happening, management doing stuff, gold going up, whatever. All of that happen, and then you get paid a lot. But how often was your Lundin Gold position rocking and rolling? Like, how often were you celebrating? Almost at no point in time. Except maybe this period here. But if you look back, even if before this rocket ride, your position would have done very, very well, and you would have beaten 19 out of 20 people in Lundin Gold. So I already went through this. Huey 2000 bottom to 2008 top. Yeah, 80% of the time miners went nowhere despite going up. So, and my point here, the only way to boost this, I mean, this is if you held from the low, and you would probably be done before. So I mean, again, but if you never sold, at least from this bottom tick, basically to the top tick, that's 1300%. If you were just hodling it. Okay, so how do you make more money than that? Again, this hodl return is going to probably be better than 19 out of 20 people's returns, because they're going to be trying to actively trade this. So how do you get even better return? Well, at any point pretty much to the top, if you deposited more money, you would be making more money at the top. How could you influence or increase the returns even more? Well, basically, throughout this 8-year period, the cheaper you bought, the better. A purchase here would make a lot more money than a purchase here. But another purchase here would still make quite a bit of money, and your overall portfolio size would be even larger. But it's like every dip here, if you could buy that, that would be great with new money. If even without dips, every additional, if you purchase more stock here, you would be losing on it first. It would go nowhere for 2 years. Then you will still have made more money. So that ended up being a good buy in a sense, because you were gonna make money on it. So I mean, if anything, I think this makes it clear just how valuable dip buying is. If a sector, or if it's a bull case, I mean, I don't invest in the sector overall, as you probably know. I don't own GDX or GDXJ, but in my mind, every single holding I have can do this, because they have stuff going on, or they're already just way too cheap, especially gold juniors. So in my mind, this is what I think my future portfolio is going to do. And lo and behold, that's basically what the pattern that one of these hodl portfolios have done. Even though it's not that impressive, because we haven't also been in a fat bull. But this is what I think my portfolio is pretty much going to do forever. Why? Because I think that on average, every holding I own is cheap. So I think My average holding is gonna either create, well, almost everyone has alpha potential. So my whole thesis, in a sense, is that the companies I own today, I think they're going to be worth more in the years ahead. They're going to have more value to them the years ahead. If I can buy them when they're already undervalued relative to the value they have today, and I don't really need to create any more value to also go up, great, even better. That's the thing. In my mind, this is what my portfolio and hodl portfolios are gonna do forever. I'm in a cron. That's why I never sell. That's why I never sell. That's why I never time. And even this hodl portfolio have done pretty well in a I mean, let's say the top was around. When was actually the top? I guess the top was here maybe. And then when the average junior is probably down, but this is still up a bit from that sentiment top. So then the question becomes like, okay, if you can make money or survive the downturns, I mean, when this actually turns into a bull market, I mean, from this low to this high, that was actually a bull leg at least, but the portfolio went up like 400-500% or something. And I think a lot of the stocks out there, they're even cheaper. They're kind of as cheap as they were here when gold price didn't really go down, but the juniors and all the miners sold off. So they weren't reflecting the gold price at all, which they are not right now either. So I think I wouldn't be surprised that right now the hodl portfolios are as cheap as they've ever been. The price to value gap on the average holding is the highest ever. I wouldn't be too surprised that. So I think the future here is pretty much as bright as I thought the future ahead for these holdings priced here was. And I've been full investor since 2015. So this is 8 years. My portfolio's been fully invested for 10 years. So you can, as we also can see in the hodl portfolio, most of the time the portfolio is going nowhere. Even okay, this happens to be a bull market, but even in the performance like it's a bull market, most of the time it's going nowhere. Most of the time in a raging in a sense bull market, in what turned out to be a historic bull market, most of the time your holdings are gonna not make new highs. The only difference again, a bull market relative to a bear market is basically that you have these consolidations in a bear market as well. Actually, I mean, bear market actually happens very quicker in a sense. This was absolutely ridiculous. But one could look at it like, okay, it made a lower low, but then it consolidated. So the next lower low didn't start until here. So that's February of 2013, May. So let's say a year or something of consolidation. Then it reached, well, here consolidated for a while, and then it reached new lows. Then it took some months before a new low was in. Then you had a net loss. Then it wasn't until October 14, a year later, new net loss period. Then that consolidated for, and again, instead of, when you have a net gain that it retraces, I mean, this retraced the loss. This was a net loss period, looking from this period of time. It retraced the whole net loss before turning down again. Here, this is a net loss period, retraced the whole loss, and much more than that, before going down again. Retrace that loss before going down. Here you have a small consolidation period. Consolidation period before a new net loss, and oh, 1 second. And this new net loss got retraced the whole way and then some. And then a new net loss period, and this was actually the bottom. So it reached a bottom here, consolidated, but there was new net loss. I mean, we can take it actually from the from the top. I mean, this is a consolidation period. Here started again, and then it consolidated for a while. And this whole, I mean, if you look at this as one net loss period, all of that got erased or retraced. So your portfolio was making new lows from the highs, though. And if you bought it here, you would be in the green for a while. And then, but in hindsight, we looked at this as consolidation. So, how in terms of time period, how often did, even in a bear, even in the worst bear ever, how often did the actual portfolio, if you only own the Hue index, how often in time, or it's like, what percentage of time did the portfolio actually make new lows? Brief period here, 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 brief period here. And most of them, if not all, retraced the entire net loss and then some before it actually peeled over. So what's really the difference between a bull and a bear market? Time-wise, a bear market is not making new highs except for new lows for except 10 to 20% maybe. And in a bull market, the same phenomena. Like, 10, maybe 10, maximum 20% of the time it's actually making new highs, and most of the new highs gets retraced. So it's two sides of the same coin, basically. Bull or bear, your portfolio, most days, you should be expecting that on any given day, there's only a slight chance, even in a bull market, that portfolio is gonna be making new highs. If we're talking index. So, which brings me to the points, like, okay, you have whatever stock you have. Let's say, I mean, it's like recent example, or take First Nordic, whatever. So it's like, okay, it went up, then it looks like it's consolidating. Is that a big thing? It's like, oh shit, it's consolidating. I should have sold the top. Man, I'm stupid. That's why I don't make any money. I don't sell the tops. No, as you can see here, I didn't sell any top. Yes, there might be some value shuffling in here, but most of the time I'm just focusing on making sure that my portfolio at all times is undervalued. That it's at all times undervalued. Because then, if you're on average right, you're gonna have an uptrend. And in this case, even an uptrend in a bear market. So what's the takeaway here? I mean, this is what's like, because like I think I commented or answered a comment, like somebody thanking me for, all the copium and getting people through it. I mean, the most important thing is, like, again, I talked about it before, it's like expectations versus reality. People who don't know better think a bull market is easy to sit through. People who don't know better think a 10-bagger is easy to sit through. People think that, if somebody made 10x on a stock over 4 years, or in the this Hue example, that somebody made 1,300% in 8 years, that means that it was pretty much going up every day. It's a bull market, so of course everybody was happy. No. It's not a big difference between a bull and a bear market, except that 10 to 20% of the time in a bull market you make new net highs, and in a bear market you make new net highs. Most of the time the sector is either going up or down, but it's not making new highs or new lows. And that's kind of, again, look at the whole portfolio. Most of the time, it's not making, well, since this is kind of a, bull market for the portfolio. Most of the time, if what I mean, if okay, I have this as a long period, but at the same time, you can look at this as being a new net high, retrace the whole goddamn thing, went up, a small new net high, retraced the whole damn thing, new minuscule net high, retraced the whole damn thing, and then some, new net high from this level here to here, retraced not only that net gain down to here, right? Retraced every single net gain down to this level. So all these net gains were retraced before turning up. This net gain more than retraced. This net gain more than retraced. So if my point is, this is what you have to be accustomed to, and this is what almost nobody gets, because it's way too much from a mental and psychological perspective. We know some facts, like 1 out of 20, like 5% of active investors beat an index. Active investors. Why don't they do that? Well, most of the time I do think, like we're seeing out there, and we're seeing in the forums, and we're seeing on Twitter, everybody's trying to predict the next move. I see market timers, I see, newsletter writers in a sense, who's like all about market timing. And kind of have to ask yourself, I guess, it's like, okay, if not only newsletters that I don't want to shit on people, but it's like, I hope you get what I'm saying without needing to spell it out. Of course, there's other ways to go about it. If you are a trader, nothing what I say makes sense. I'm talking from the perspective of price is what you pay, value is what you get, and over the long term, that is gonna shine through, and that's why you're gonna have positive returns. Not every month, not every year, certainly not every day or every week, but over the long term. If you bought something and hold them until they're not as cheap, you're gonna be making money. When that is, no idea. I thought juniors were going to be hundreds of percent higher today, given where gold is. So, again, surprised. I don't know. I can't tell. I never know. I don't know when somebody's going to care about the obvious, let's say, because most people are momentum hunters and have very short time frames. And especially if you have a case that's like, hey, if this works out, there's going to be 50 positive news releases over 3 years. Well, you have to wait through 50 news releases in a row for 3 years. And if that ends up being, fortunate outcomes on average, you're going to make money. That's it. But you still have to wait through 50 news releases. You might make some money if you hold through one news release that you write on that proves to be positive. More money if you hold to 10 of net positive news releases. More if you hold through 20 net positive news releases. Because let's imagine this is a stock with some alpha potential. You bought it here. After 10 news releases, the price is up here because they've increased value. 10 news releases later, stock is up here because 20 news releases of value creation. Maybe the deposit went from 0 to 1 million ounces here, 1 million ounces to 2 million ounces here. 10 news releases later, you're up to 30. All of a sudden, the endowment is 3 million ounces. Then it makes sense. The biggest gap is obviously going from 0 to 3 million, not 2 million to 3 million. The longer time, the more news releases, the more things can go right, the bigger the change in the price way back when and value way back when to future value and future price. So everything is basically, the gist of it is like 95% is waiting. And this shows that that's the case in a bull and even bear, 90% of the time it's actually not making new lows. But the surprise in a bull, or if you have a stock that's gonna if you're in a stock like whatever, Snowline, Lundin Gold. Okay, where's Snowline? Anyway, Lundin Gold case that absolutely worked out. The net surprises to the, or it was a case, an intact case that created value. Still, the surprises were to the upside. The net, I should say, net surprises were to the upside, but it only happened for like 5% of the time. And you never know exactly when that's going to happen. So you have to hold. If you think something is cheap, in the end, the net surprises are going to be to the upside. If what you hold is not cheap, it's actually overvalued, or is proven to be overvalued, the net surprises are going to get to the down. You never really know beforehand, right? We're always holding something we think is cheap, especially if you're a value investor. So my belief is that net surprises are going to come to the upside. But in the meantime, I'm going to have consolidations. And consolidations typically involve a lot of down days, a lot of down weeks, a lot of down months, a lot of sideways actions for extended periods of time. So again, the only difference between a bull and a bear market is that the net change surprises comes to the upside in a bull market like 10% of the time, and in a bear market it's comes to the downside 10% of the time. 90% of the time these stocks are just oscillating, not making new lows or not making new highs. And every consolidation can be year or years. And you see, you know this is true. Look at any stock forum. As soon as a junior has been consolidating for a week, a month, that's already too long. That's already too long. It's too boring, not enough action, I'm losing money on paper, too much to bear, this is not working, and I need to get something else because now I have a paper loss over the last week, so I gotta find something to rectify that, so I gotta buy something that's actually going up right now because then I think it's gonna go up tomorrow. That's like almost everyone. You can look at it. And yes, you can, I mean, if you're a very good short-term trader, you can theoretically make money doing that and make money over time. How are you going to do that if things go well, that your portfolio gets bigger and you're in, typically the most mispriced companies are the smaller companies, and some of them have very low liquidity. How are you going to scale that strategy? Are you going to start flipping the S&P 500 or something? Well, okay, that's probably super hard. Whereas like from where I'm coming from, it's like I'm a value investor. The junior sector is the most irrational sector I've ever seen. It's like stealing candy from a baby. But even if I'm stealing candy from a baby, that doesn't mean I'm going to be eating candy all day. I might be eating candy 10% of the time. So, and going back to what I talked about before, if you're at extremes in a sense, especially if you're a value investor, if you're a price to value connoisseur, this was extreme. Next obvious big wave is to the upside, I would say. For juniors right now, I still, even though minors are up here, still the next big move to the upside for the next obvious big move for juniors is up because they're so cheap, right? So that makes me obviously very bullish, and why I want to hold them. Why? Because I think the net surprises are going to come to the upside. In the meantime, today, my portfolio is probably down. I haven't checked. It's probably down. Might be down tomorrow. Might be down 3 days from now. Might be down a week from now. Might be down a month from now, 2 months from now, 3 months from now. Sooner or later, the net surprise, they're going to go up. And then net surprise is going to be to the upside. And when that happens, they might retrace the entire move pretty much. And I might again suck my thumb for months or something before it goes up. Exactly what the HODL portfolio is showing. That's why again it's like I don't want to need, let's say, providing copium every single day the sector is down, or every week. Once you get this, and believe me, it's not like, if this was so easy to do in 2025 for the average person, they would do it. It is not that easy. You have to kind of, it's a leap of faith. I think whatever I own is cheap. The market obviously does not agree with me, because if you're looking at the market, it's suggesting that the price and value is the same and price is down here. But I'm thinking, hey, I think the value is 200% higher. I think the value could be 500% higher in 3 years. That's what I get a bet on. If I'm right, I might be up 500% in 3 years. If I'm wrong, I might lose money. But you never know. So you have to bet on something. Like, you have to take a stand. But most people are trying to get the next move correct. That's like 90% of all the trading is short-term focused. And again, people are not selling your favorite junior, which you think is dirt cheap, even at almost record high gold prices. They're not selling that today because they think it's overvalued. They're selling it because they think somebody else is going to sell it lower tomorrow. They think the short-term trend is all of a sudden down while it was up yesterday. That's why they're selling. They're selling because today could be the start of a trend. Nobody has any idea really what they're doing, and nobody can really predict the markets. I certainly can't predict the gold price or the silver price. I can't really predict the short-term junior movement, but I can predict that if a company I own today that's priced at whatever, if they have money and they're set out to do something, let's say, if they give me 20 news releases over 2 years, I think there's a chance that they've increased price, and this current increased value in this current price is unsustainable, and that's going to be reflected. That is a pretty simple bet. And from a quality of life perspective, do I want to need to watch the markets every single day, keep up with every single chart? I mean, there's some who do that and they're full-time traders pretty much. I'm a full-time investor. I'm not a full-time trader. For some reason, my portfolio seems to do best when I'm on vacations. When I can't even, I don't watch the sector, I don't watch the portfolio that often, I don't make any trades. For some reason, my the best time periods seem to be when I'm on vacation. The portfolio performs better when I'm not even looking at it, for some magical reason. That is, in my opinion, quite good quality. It's like, if you have, and that's the setup for the HODL folios, because I don't want to need looking at the portfolio every day. I don't want to be needing to trade 6 different portfolios. So I bet on things I think are cheap, right? Either right now or might look very cheap in the future. Some may work, some may not work. But on average, yes, that's proven to be correct. And even shit poor sentiment and decreasing sentiment has not been able to withstand that, let's say, value creation. Because sure, if an ounce in the ground is valued at 50, you're buying it for 50 million, let's say. If they double the amount of ounces, should be valued at 100. But if sentiment goes down and you're only getting $40 per ounce in the ground because of sentiment reasons, then it's only going to trade at 80. But that's still a positive. So in a sense, if the value of a company doubles, let's say, sentiment and this is excluding dilution. If the value of a company doubles, it doubles the amount of ounces, let's say, the sentiment needs to get cut in half, double the depression, let's say. So if I buy something valued at $50 per ounce, it increases the amount of ounces by 100%. It should double with the same price per ounce given by Mr. Market in whatever mood he is, same mood. If the market gets much more depressed, maybe an ounce in the ground gets valued at 25. In that case, even with a doubling in ounces, I'm trading water. The position is even though value or amount of ounces have doubled. And that's kind of what I consider these consolidation periods, let's say, to be. They're not yet reflecting the amount of value that's been created. Then they reflect it, but again, keep in mind that the sentiment was getting worse and worse over this time. So actually, I think the portfolio probably created more value over this period of time than it looks by the share price here. And now, of course, with a record high gold price, they're probably more undervalued than ever. But I think this here is like, well, I mean, if you want to do TA about it, I mean, I think obviously I think this is going to surpass this high sooner or later and have something like this, like a bowl type bottom, even if this is a portfolio, not a stock. But you can look at it, Huey or whatever. It's like, okay, double bottom, poof, higher, some kind of thing, a bowl, whatever you would call it, saucer bottom, and then it gets going, and I don't know what this is supposed to be, but here you have a kind of a bowl thing, and then goes higher. So if your portfolio is not up today or any day, or you're down in it for a week or a month or months, that does not mean we're not in a bull market. That does not mean your portfolio is not going to be making a lot of money. That does not mean that the trend of the portfolio is not up. Because if you look at this period of time, okay, you look like an asshole. This period of time, look like a genius. This period of time, asshole, genius. Whereas the only important thing at the end of the day is our long-term total portfolio returns. As long as the long-term trend is up, it doesn't matter if you have a bunch of 50% corrections in between. But if you need to be right in a short time frame, then it's going to be much harder. I mean, again, it's like I can obviously see that this sector has never been cheaper. But if I'm a short-term trader, what's the difference? I mean, if you're at the extreme high, if I'm a trader, well, this is a breakout to a new high, so my bet is going to be to the upside, I guess. And here, okay, this doesn't show it, but there was a brief break down here. So if I'm a trader, I'm going to be betting on it's going to go lower, because last time it broke like this. Yeah, this broke below the resistance support lines here. So I mean, why wouldn't it do like this? So that's obviously what traders were thinking. Then it turned on a dime, and that was the fake out bottom. So if you're gonna wanna look right in the short term and make money all the time, then you're guessing what the next short term move is, even at extremes. You're going to be longing Nvidia at 200 PE because it might go up 30%, or Tesla, whatever you want to bet on. But the next obvious big move might be, probably down if it's overvalued. Anyway, I hope again this makes sense. And again, it's like this is what kinda frustrates me, because I see people who follow me on Twitter and have been following me for months. And I keep putting, I don't think, one guy in particular, I don't think he watches these videos or anything. So it's like he doesn't want to spend the time, whatever. So he's just complaining every single day. So it doesn't matter what I say, because he doesn't get it, and he's maybe never going to get it. If you get this, and if you get that this is how a bull market can look, this is how a bull market can look, where basically you're either not making money or losing money most of the time, and it's still not going to matter. and it's just pretty similar to a bear market, just that the surprises come 10% of the time to the downside, then you're going to stop waiting for something to happen every freaking day. Think about it. It's like, assume you're only going to be happy 10% of the time, and that's going to be enough to make money. Then you're not going to be waiting or taking it too personally. Oh, my portfolio is not up today, or it's down today, and tomorrow it's down again, and you're like, oh, I'm getting increasingly angry here. I'm getting increasingly frustrated. Well, try to sit through a bull market, or try to sit through a 10-bagger. Try to sit through Lundin Gold and have a 15-bag or whatever. Good luck. Good luck. If you think the only time your portfolio is working or whatever, if you think profitable investing is about the portfolio making new net highs every day, good luck. You might be right on, in this case, 5% of the time. 5% of the time. So 1 in 20 months, basically, is when you're actually going to be shearing. And if you're bitching about every single down day or every single down week, you have no chance, absolutely no chance to hold a 10-bagger, let alone ride a bull market. No chance whatsoever, not even remotely close to be able to make any serious money. So once you start to understand that a bull market is basically a bear market, it's just that the surprises come now and then to the upside, and when it comes, it even retraces pretty much the whole upside surprise before going higher. So basically, if you can accept the fact that, in a sense, your portfolio is not going to go up almost at any point in time, except when you look back years later, then if you accept that, you're going to stop bitching about every down day. You're going to start to accept that that's exactly how a bull market works. That's exactly the pattern you see in 10-baggers. Most of the time, they absolutely do not go higher. Unfortunately, I don't have Great Bear up here, but exactly the same thing in Great Bear. The amount of period people who were probably actually, really excited in Great Bear, less than 5%, I think, of the time. But with that said, that's the thing, it's like, why? How can I hold? How can I be fully invested for 10 years? Because I'm excited about the companies I own. I'm thinking of what they might be trading at some point in the future, and I'm thinking when they go down and get cheaper, I'm thinking how much money I'm going to be making in 2 years' time from buying it at this ridiculous price and just holding it. So in my mind, every single down day is part of a consolidation for my average junior. And consolidations happen before action periods, let's say, and then consolidate an action period, consolidate action period. So if we're consolidating in any junior, and you're going to be shown to be right that it's undervalued, we're getting closer and closer to the action period. And then that might be over in a week, and then we're back to consolidation again. That's why I don't really share any updates in terms of price, because I know how quickly that can be retraced, and I don't care too much about the declines because I know how quickly they can be retraced. If I'm right on the fundamentals, I'm going to make money. If I'm right on the fundamentals, I'm going to make money. Sooner or later, I'm going to make money. And I don't think I've ever been more bullish on the fundamentals than I am today. And I expect to just keep making money in this sector, while looking dumb for 80% of the time. If you want to look smart all the time, do something else. Don't go into investing. Start to, start short-term trading and basically turn your hair gray, and probably you're going to lose money. You can pick. Either you want to look right all the time or you want to make money. If you want to make money, you gotta accept that you're probably gonna look wrong 80% of the time, and the portfolio is gonna uh, not be impressive. Except for when you look back years from now, and you'll see that okay, on average, I was actually right that they were undervalued. Yeah. So again, it's like this is I mean, it's not like I think a lot of people are starting to well, especially people who actually listen to these YouTube videos, they're starting to get it. That's like, but that's the thing. Again, the most important thing I think is like have your expectations correct, because if you have no idea what to expect, you're gonna be alarm bells are gonna be ringing every time a position is down. Because you have no idea how even a bull market behaves or even a 10 bagger behaves. So you're going to be thinking every time you see red in your portfolio, it's like, yeah, alarm bell goes off. Something is wrong. I need to do something. No, no, that's absolutely not the case. Absolutely not the case. A bull market has pretty much as many red days as a bear market. It's just that the surprises come to the upside 10% of the time. If you start to accept that you're probably doing something wrong if your portfolio is very exciting from a price perspective, or if it is exciting, prepare for it to be the opposite of exciting soon. This London gold, the only time this was really exciting was basically in the last one and a half month when gold did a record setting run. That's the only time really this was actually really exciting. And I guess yeah, this period here. But it's like again, net gains, no, almost never. The only thing that was exciting really about this chart is the returns one would have had if one sat in it for 5 years, and those would be really exciting. Anyway, I hope you get my point. If I talked about any juniors, assume I'm biased. Not investing advice, not buy or sell recommendations. Don't invest money you cannot afford to lose, or don't, especially not invest money you need in a short time frame. Yeah, all of that. Basically, I mean, hit the like button if you appreciate this. I guess. Yeah, thanks for listening. Bye bye.